There we go. All righty. Hello, everybody. Sorry for the delayed start. I was just wrapping up a call with a client. So I'm going to hop right into it because I know we are at our starting point here of 11 Central Standard Time. So thank you all first and foremost to attending our webinar today. This has been a part of our ongoing financial education, financial wellness series that we've been doing for members of our local hospital systems as well as affiliate partners. This week, we are going to be talking all about life insurance, everybody's favorite topic, right? So let me swing over to my presentation and we'll kind of dig right in here. So with that, my name is Lucas Amel. For those of you that do not know me, I am a fully licensed fiduciary financial planner with West Point Financial Group. We're a Mass Mutual firm based in the Midwest. We've got offices all over the place. We've got them in Indiana, Chicagoland area, and then of course Wisconsin, where I'm based. But I'm servicing, clients all over the country. Me and my team collectively, we're overseeing the administration of over $250 million in assets and have thousands and thousands of insurance policies under us. So I'm quite confident that I'm a good speaker for today's event. As I swim in this space, I breathe in this space all the time. So our topic today, like I said, we're going to be covering whole life insurance as a financial asset. Whole life insurance is a very, very misunderstood asset class. So I want to make sure that we're kind of going through the pros, the cons, and of course, how it might make sense to be utilized when it comes to your overall financial plan. So with that, just know everything that I'm going to be going through today, it's not, although I'm a financial planner, I'm not a CPA, nor am I a lawyer. So nothing that I'm going through today is to be considered individualized, personalized tax advice, nor is it individualized legal advice. This is just to help all of the attendees today, as well as those that view the recording, to help understand, what is this life insurance concept? What is whole life? I'm sure you've heard good things about it. I'm sure you've heard bad things about it. That's why we wanted to make sure to host this webinar today, just to kind of help clear the air, hear an objective opinion on actually what it is, how it's utilized in financial plans. If you follow Dave Ramsey, he's not a big fan of it. And I'm sure some of you are chuckling, but just know that Dave Ramsey's audience, he's speaking to the masses. The average American household is actually only bringing in about $55,000 a year. So when he says, hey, whole life insurance is not where you should be putting your money, you should be putting it in an index fund. I hear that all the time. I think that's very accurate when it doesn't make sense for somebody's financial situation. When it comes to this, you should be maxing out your 401k match. You should be looking at investing in Roth IRAs. Life insurance, especially whole life, is not a standalone solution when it comes to building and constructing a financial plan and a retirement plan. It is a component if it makes sense and if you're already utilizing certain other things. So let's kind of dive into it. Like I said, whole life insurance is a financial asset. So when a lot of people are thinking about life insurance, they're thinking of it as, hey, this is just another bill that I have to pay. I'm not really going to need it unless some kind of crazy accident happens. And, I'm personally not going to be benefiting from it. It's going to be for my kids, right? So when we kind of actually dive into it, a lot of these aren't true, especially when we're looking at the whole life side of things. Okay. So whole life insurance is meant to be a component of your overall financial strategy. Now, with a financial strategy, that's of course going to be built up of a lot of different facets. All right. So we're going to have real estate, whether you're a homeowner, whether you own some rental properties or multifamily properties that are generating you cash flow. That's an important thing to, factor in. When it comes to investments, this is kind of like what I was saying too, kind of grouping it together with the retirement accounts underneath it there is you should still have a 401k. First and foremost, you should be maxing out and taking advantage of any kind of employer matches that you're going to be receiving from a 401k or a 403b account. There's no other place where you can put $1 and it automatically doubles, meaning like a 401k match. Some of you may own businesses or kind of like 1099 gigs that you're doing on the side. Whole life insurance is a factor of this whole picture. And like I was saying, every person's financial strategy and their mix of these things is going to look different based on occupation, based on income level, based on family structure. So this is just to go high level to help all of you understand how that can be important and the benefits of them. So when we're looking at whole life insurance, what are the components? Why is it considered a financial asset? And I think it's very important, kind of going back to what I was saying right here, to delineate the difference between whole life insurance and term life insurance. So there's two main kinds, right? So when it comes to term life insurance, as the name implies, term life insurance is going to cover you, or at least the insured, for a specific term, right? So a period of time or a window that you have that insurance. So say you're paying $30 a month and your term is 20 years for $250,000. What the insurance company is contractually agreeing with you is saying, hey, as long as you're paying this $30 a month, if something happens to you within this 20-year window, we will pay your beneficiaries a tax-free distribution of $250,000. If something happens outside of that 20-year window, you're not going to receive anything. So in essence, kind of going to some of these, thoughts about life insurance, hey, it's just another bill that I have to pay. I probably am not going to need it. I'm not going to benefit from it. Say you're shoveling $30 a month into a term policy, nothing happens to you within that 20 years, your term policy expired, and truthfully, it was kind of another bill. The issue with that is the whole purpose of insurance is to protect against uncertainty, right? I've had an unfortunate number of term insurance claims of young, healthy individuals who were involved in an accident. To that point, a lot of people say, well, I'm not going to directly benefit from it. Yes, that's true. But if you really care about your family and you're not there to provide them with your income anymore, it's a way to replace that so you at least have the peace of mind knowing, hey, with certainty, my family will be able to sustain their lifestyle if something happens to me and I'm not able to bring in an income anymore. So that's kind of how term works. On the permanent side of things, it gets a lot more complicated, but I'm going to try my best to help simplify it for you. All right. So with permanent life insurance, one thing that's very important to note is that permanent life insurance policies have a cash value component. So with that, the premiums that you're putting into them, unlike a term insurance policy, there's a pool of residual value called the cash value that you as the policy owner actually have access to. So going back to, thoughts about life insurance is, hey, there's no benefit to this for me. With a whole life insurance policy, there is a cash value component that a portion of your premiums are flowing into. So not only do you have a death benefit component, but there's also a cash value. Now, it's important too to note if you are looking into permanent life insurance, whole life, or cash value, they're all synonymous, everything I just said. They're basically just saying whole life insurance. Is how is the cash value treated? I'm hearing a lot more people nowadays look into indexed universal life policies. It's kind of a buzzword, especially on the social media channels, that's the best way to invest your money right now because your money's going in and it's invested, but also it's life insurance, and then there's these tax benefits. IULs are very popular. I think they have their place, but at the same time, I'm seeing them slowly become less popular because people are understanding them a little better. And it's because of this next portion, it's this guarantee portion. With those IUL policies, index universal life policies, one of the guarantees that are associated with them is that they're guarantee that every year the cost of your insurance goes up, right? So it's bleeding into your cash value. If you have questions on IUL versus participating whole life, reach out to me directly because I could do a whole presentation and I don't want to get on a soapbox about it. But going back to what I was saying, the cash value, it's there for you to use. So unlike a 401k, the cash value within a life insurance contract is accessible to you as the policy owner, no matter what your age is. So there's no early distribution rules like a 401k, and there's actually no tax implications if you're tapping into the cash value via policy loans, as I'll kind of talk about a little more here. But just know that the cash value pool is a residual pool of income that you have based on the premiums that you're paying that you can use at any age for any type of expenses, no questions asked. So there's a lot of tax benefits with that, whether you're trying to supplement your income and you want to keep below a certain tax bracket in retirement or prior to retirement. This is a good option. When it comes to utilizing the tax value, one thing that I always want to kind of emphasize, and this is why we do a lot of work with Mass Mutual specifically, is that when you borrow from the cash value, how is the reoccurring growth of that cash value being affected? So going to this next category, this guarantee column, a lot of these insurance companies, like specifically mutual oriented companies like Northwestern Mutual, Mass Mutual, New York Life, Penn Mutual, Omaha, they have some kind of guarantee provision. First of all, your cash value does not go down. Okay. So if the market declines 10, 15, 20%, your cash value is unaffected. That's kind of a guarantee that they give you. Another guarantee is hopefully some degree of a dividend, which is actually the next little thing here, is that the cash value year after year, based on company performance, is going to credit you a dividend, assuming you're staying within these mutual company chassis. If you have questions on how many there are or what the best ones are, let me know directly. But the cash value is being credited these dividends. So going back to my example before, saying, hey, well, what if I want to access my cash value tax-free? What does that look like, or how does that impact it? There's certain companies that are out there. There's three specifically, Penn Mutual, Mass Mutual, and New York Life, that if you access the cash value from your policy, say you pulled $10,000 out, right? Every other insurance company besides the three that I just mentioned is going to directly recognize that you pulled money out of the cash value and only credit you a dividend on the remainder of the funds within there. However, the three that I did mention, once again, they are Penn Mutual, Mass Mutual, and New York Life. They indirectly recognize that you actually tapped into that cash value. So in our same example, you pulled that $10,000 out. Say that year their declared dividend rate was 6%. With the other companies, you don't get that $600 because you took the loan out. With the three that I mentioned that have this non-direct dividend recognition, they will still credit your cash value $600. So there's a lot of borrowing capabilities within these, as I mentioned, and it can be very tax advantaged. Look at that. I wasn't really looking at it, but so those are kind of the big facets as to how these asset classes work for you. So when we look specifically at the tax advantage component, there's a couple different things with life insurance just in general, but specifically whole life, right? So when we look at the death benefit component of life insurance, whether it's whole life insurance or term insurance or stuff that you're getting through work, right? The death benefit, so what would go to your beneficiaries, is always going to be tax-free, which is substantial. So a lot of planning opportunities arise from this when we're looking at full estates. Okay, so I deal with this on a regular basis. I'm helping people kind of unwind the taxability of their inheritance or their estate to the beneficiaries, because most people have accumulated all of their assets in these pre-tax retirement accounts. Okay, so like a 401k or traditional IRA. Now they know, hey, within the next couple years, I'm going to kick the bucket and this is all going to the kids and the grandkids. It's unfortunate, but upon inheritance, most oftentimes the individuals who are inheriting from an older generation are at the peak earning years of their career. So they're already in a really, really high tax bracket, right? Then they inherit $200,000, $500,000, and all of that money is subject to tax. So it shoves them significantly higher in an already high tax situation. So what a lot of people will do when they're planning their estate, if that's the scenario, is have some kind of permanent policy in place or even a term. It's harder to plan with certainty with term, where they would be able to cover the taxes on their estate for the beneficiaries with their life insurance policy, because that comes to you tax-free. So it's a way of offsetting those estate planning issues, but also too, say, a spouse and a spouse are going through their life and one of them kicks the bucket, any insurance benefits that would get paid to the surviving spouse would be tax-free as well. The second big tax benefit with life insurance, and this only applies to the whole life because we're talking about cash value, is that any growth that's occurring within the cash value component is tax deferred. So going back to my example is saying, hey, there's these dividends that these companies are paying to the cash value. Those dividends, you're not realizing any kind of taxes on the growth of your cash value. There are some caveats to that. So like I mentioned, the tax benefits kind of stay if and only if you would borrow from the cash value via a loan. If you chose to electively pull from the cash value as like a full distribution, it would actually decrease your death benefit, as well as you would have to pay some degree of tax on the portion of that distribution that's considered gains. So that's why more people look towards the loans, especially if they can continue to receive the dividend as if they never took that money out. But just know that as these contracts or as the cash value is growing, that growth is contained within the policy. So it's tax deferred. It works similar to a 401k, where every year, hopefully you're seeing growth coming from market appreciation, dividends, as well as interest. A benefit of those retirement accounts is that every year it's not spitting off capital gains, interest, and dividends. Life insurance works the same way. Whereas if you had a brokerage account outside of a 401k or an IRA, every year you have to pay taxes on any gains that you realized, any dividends that were paid, or any interest that accrued. So when you look side by side, say you have the same portfolio or the same investment in a qualified retirement account that has tax deferral versus a non-qualified retirement account that has no tax benefits, over time, the one that has tax deferral will significantly outperform the one that doesn't have that tax deferral, because every year taxes are dragging down your investment returns. So that's another benefit of life insurance, is that they are deferring any kind of capital appreciation that we're experiencing. So like I said, when you actually want access to the cash value within whole life contracts, those can be tax advantaged if you choose for them to be. They're tax advantaged if you're doing it via policy loans, because there's no taxes associated. There are slight interest charges, but typically the dividend significantly outpaces anything that you would be charged in interest. All right, so kind of looking at this, I ironically just kind of was talking about this already, is kind of looking at the different asset classes that are out there and how they kind of factor in. So, there's three main ways that we can sort of break up how money is saved and invested. First of all, there's taxable, where the money that you're putting into it, you've already been taxed on, okay? And then any earnings, so capital gains, interest, dividends, those are also taxable. So an example of this would be like a Robinhood account, or if you opened an account at Fidelity and it was not a traditional IRA or a Roth IRA, it was just a basic brokerage account, as they're kind of called. So they've got pros, they've got cons. There's no, restrictions associated with how old you need to be to access the funds without penalty. There's less of a tax implication sometimes based on like accessing the funds, but just know that that's how they work. These tax deferred accounts is another one that we're looking at, where the money that you put in, you've not been taxed on. So this is like a 401k or a traditional IRA. You put the money in, you never pay taxes on that money, or you receive a tax deduction putting that money in. It grows tax deferred, as I mentioned. So capital gains, they're null and void in this account. Dividends, null and void. Interest, null and void. It's not spitting out onto your tax return. It's contained within the account and grows along with the account. However, the last one's the caveat here, right? When you choose to take a distribution from a tax deferred account, you have to pay taxes on it. All right. So that's the big issue with those. It's not bad. It's just, it is what it is. And you have to have proper planning in place to make sure that you're taking distributions from these effectively. Because one of the biggest things that I see with folks is that they're in retirement, they take their Social Security, maybe they have a pension on, all of their money is in these tax deferred accounts that the distributions are taxable. And when they take those distributions, it can make more of their Social Security taxable. So you always want to be careful when you're playing with the distributions with your financial plan to make sure that you're optimizing your Social Security benefit by proper tax planning. That's why you don't want all of your money in those tax deferred accounts, if possible. Now, these tax favored, There's two types of accounts here. So the money that goes into these, you've already paid taxes on. However, they still share that same tax deferred strategy where the taxes are deferred. You're not paying gains, you're not paying dividends, you're not paying interest. And when you want access to the money, that money comes to you tax free. Okay. There's two main account types that you can do this with. There is a Roth IRA or a Roth 401k, and there is whole life insurance. Okay, so those are the only two. For a long time, they've called whole life insurance the rich man Roth IRA because you are limited based on your income access to a Roth IRA. Once your income goes over a certain threshold, you actually cannot directly contribute to a Roth IRA. There's a couple of ways around this. There's something known as a backdoor Roth IRA contribution where you make a non-deductible contribution to a traditional IRA and then you immediately convert it to a Roth IRA. Technically, that does not have an income limitation. However, they do look at the basis of all of your IRAs. They don't count 401ks, but they look at IRAs. So if you already had an IRA for $200,000 and then you say, well, hey, I want to put $6,000 a year into my Roth. I want to get up to the max. I think it's 7 now. You can't really do that if you already have an existing IRA. They look at it and start factoring in and they'll start gouging you on taxes. So anyway, sorry, I know I throw a lot at you guys, but I just want to try to put as much out there to make you educated on this. And if something resonates with you, just reach out to me directly and we can talk about it. So with the life insurance side of things, with whole life being in that tax favored bucket, there are no income restrictions associated with that. So you can earn any degree of income and participate in the tax favored life insurance. And there's no contribution limits to that. You know, I have some clients who are putting 6 figures a year into life insurance. They can do whatever number they want. Whereas with a Roth IRA, you're limited to your contribution per person based on whatever the IRS says for that year. So like, for example, 2024, you're only able to put $7,000 into a Roth IRA, 8,000 if you're over 50. With whole life insurance, you can put 70,000 in a year, whatever the number looks like. So it gives you a lot more flexibility above and beyond those other types of accounts. So continuing on that note, and this is why it's meant to be in conjunction with some of the stuff that you're already doing, is that life insurance is dependable. It's dependable in tough times. I know this might not show it as drastically, but I'm sure all of you know and have experienced that the stock market zigs and it zags. It goes up, it goes down, it goes sideways. You know, it's unpredictable. However, the stock market is the way that you're always going to see the best aggregated performance over time. You know, when we look at the stock market, I think the S&P 500, which is the standard measure of stock market growth and performance, the average rate of return on that is between 9 and 10%, but that's because they zoom it way out, you know. So with life insurance, and this is where it comes into retirement planning, or it just comes into having more robust of a financial situation, is when the market's having these dips, like we saw, you know, after COVID, we saw a significant decline. Oh, I'm sorry, that's over here. But like even too, when we're looking at the period over here from 2000 basically until 2007, we didn't see any growth during that period. If anything, we saw a decline and then a recovery. So, for example, say you needed money right here, right in around 2003, something like that, and the market was down 15%, you do not want to tap into your 401ks, your IRAs if they're down 10 or 15%. what you would do is if you have this kind of strategy already in place and you need the funds, you can utilize the cash value from your life insurance policies, because remember what I said, they're contractually guaranteeing that you're not exposed to the market. You just have this pool of cash value. It never goes down. Okay. It goes down if you pull money out, but it doesn't go down if the market declines. So, what people will do, whether they're in retirement or they just need money, is look and see, okay, well, where is the stock market right now? Is it doing well? Great. Are we up here? Okay, great. Let's shave a little off the top of our growth to help supplement our income. However, if the market's down, the adage in the financial world when it comes to investing is you want to buy low and sell high, right? Well, if the market's down, you're doing the opposite. You bought high and now you're selling low. You want time for those assets to recover. So, what a lot of folks will do with their retirement plan, and this is proven in the financial world and by multiple PhDs, is having a combination of the two drastically elongates the longevity of your portfolio, is because you can give those assets time to recover instead of shaving down and pulling income off when the assets are depreciated in a down market. So life insurance gives us a fixed bucket that we can pull from in those down times or in those difficult markets. However, in the up markets, you're going to get the declared dividend. Well, you get the declared dividend in a down market too. Then most of the big carriers that are out there that I've mentioned and more, they pay a dividend every year because it looks significantly better on their track record. So just know that it's not meant as a standalone thing, right? So kind of going into this, what are the 5 main reasons that people would own life insurance, right? Or whole life specifically? First and foremost, protecting our family, protecting our financial security, whether that's individual or business related. Business owners are probably one of the biggest holders of whole life insurance because they see the value on it, both from borrowing capability and predictable exit planning. But from a family standpoint, like I said, first of all, it gives you the security if something happens to you, with certainty you're leaving a death benefit. But also, too, those death benefits are guaranteed for life, unlike term policies. Reason number 2, cash or credit when you need it. Like I said, there's no age restrictions around whole life insurance, nor is there any kind of penalties associated with accessing it prior to 59 and a half. So a lot of people on this, I've heard pushback saying like, oh, well, my 401k allows me to take loans out of it, and that's not penalized. That's absolutely true. But what I always bring up to people in those circumstances is really like, okay, well, do you want to pay taxes on that money twice? And then they kind of pause and they'll be like, okay, well, Lucas, what do you mean? So when you take a loan out from your 401k, it comes to you as tax-free income, correct? Right? So the issue with that is you have to pay that loan back, right? So say you pulled 10 grand out from your 401k via a loan, so you didn't get the penalty. They're going to assess you an interest rate, and they're going to say, okay, well, you need to pay this loan back within X years, and it's going to cost you this much a month. Well, that amount per month is being paid by income that you earned and you're paying taxes on. Okay, so you pulled $10,000 out of your 401k, you earned income and you paid taxes on the $10,000 to make the 401k whole. When you choose to utilize that $10,000 in the future in retirement, you have to pay taxes on it again. So that's why I'm really not a big fan of 401k loans unless somebody's really in a pinch and they need to do it. But that's always how I kind of frame it for people to help them understand is in reality, when you're accessing money from your 401k via a loan, you're technically paying taxes on it twice. Whereas with the life insurance, the money that you're putting into the cash value, you've paid taxes on. When you want access to the loan, you do not need to pay taxes on it. And then the loan, you never need to pay it back within a life insurance policy. So either the dividend will slowly pay it back over time, which is a non-taxable event, or you just leave the loan within your policy, and then when you pass away, your death benefit is just netted off the cost of the loan. So say, for example, you have a $100,000 death benefit, you pulled 10 grand out in a loan, you pass away within a year or two, your beneficiaries would receive the $100,000 death benefit less the value of the $10,000 loan for the amount of $90,000. Okay, so it gives a lot more flexibility for the unpredictability that we know as life, right? So reason number 3, additional financial security during your retirement. Realistically, that's speaking directly to the screen, is that we don't want you spending down your assets if they're currently depreciated based on what's happening in the stock market. What this gives us is a safe pool that we can tap into to help weather the storms of volatility or market uncertainty, right? So 4th reason, it's additional funds that can help meet medical or long-term care expenses. A lot of people, when I bring up long-term care insurance, I always get the poo-poo looks, right? Give me 1 second here. I'm talking a lot. You always get the poo-poo look saying, that stuff's a ripoff. It's too expensive. My grandparents had it and it doesn't do anything. The long-term care insurance space has really sort of faded away as standalone long-term care policies. The newer thing that's out there now is hybrid products. Okay. So it's basically putting a long-term care rider on an existing whole life, well, you have to do it from the beginning, on a whole life policy. So the whole life policy will have everything that I just discussed. It'll have a cash value component. It'll have a death benefit component. But what you can actually do if you set it up properly from the beginning, and it has to be from the beginning, is that you can actually have it so there's a pool above and beyond the death benefit that you can actually utilize during your lifetime to help pay for medical long-term care related expenses. So that's kind of the way of the future with it. And what we're seeing the biggest inflow in the industry into is nobody buys standalone long-term care insurance policies anymore. They're always hybridized, where it's basically you're able to accelerate the death benefit that you currently have. So say you got $250,000 in a permanent life insurance policy death benefit. What the insurance company will do is if you can prove that you can't perform 2 of the 6 activities of daily living, or ADLs, they call them. So you can't dress yourself, bathe yourself, feed yourself, go toilet. There's one other one that I kind of forget. If you have a doctor note saying, hey, I can't basically take care of myself, they allow you to start spending down the death benefit while you're still alive. And then any remainder, of course, would go to your beneficiaries. But it's a way of leveraging your money and how it's positioned to help cover the costs that unfortunately are a reality. I mean, statistics go up every year, but I think the last time I checked, 70% of people over the age of 65 will spend at least 2 years in some kind of long-term care scenario. So it's a real cost that's associated when it comes to retirement. It should be a part of your plan. I know it's the least fun thing to think about, but it's reality. And most people know somebody, whether it's a parent or a grandparent who they had to go through that, and it's no fun, but it's better to be financially responsible about it than bank on Medicare covering or Medicaid covering the costs and putting mom or grandma in a shared room in a cheap nursing home. So That's the one thing. So reason five, a little more positive now. Sorry about that. Reason number five to own whole life insurance is just it's a financial legacy, right? It's a way of guaranteeing that you can pass on a big lump sum of tax-free money to future generations, whether it's kids or grandkids, helping pay for colleges for people, helping start businesses, helping buy more real estate. The wealthy historically have transitioned the most wealth through life insurance because it's guaranteed and then there's no rules attached to it. So what I mean by that is like with 401ks, with IRAs, when people are inheriting that money, the IRS has passed new rules. There used to be stretch rules where they could stretch out the distributions over their lifetimes. Now the IRS is basically requiring your beneficiaries to pay down or spend down an inherited pre-tax or tax favored account within 10 years, right? So with life insurance, there's no requirements on that. They just get a big tax-free lump sum of money and they can invest it how they want. Alternatively, with the 401k, they have to start spending that money down and doing something different with it because the IRS doesn't want you to generationally keep deferring taxes. So life insurance is without a doubt the most effective way to leave a legacy, to transition it. So for the last, 10 minutes that we've got here, I'm just going to go through some different examples, right? And kind of discuss, going over the 5 reasons to own it, where they would kind of fit in with an individual circumstance, and of course, the different ages that they're applicable, right? So if we look at reason one, now just to be clear, all of these reasons apply to all ages, but we'll kind of just make up little stories for you. Reason number one, say you're in your early, mid, late 30s, life insurance, first and foremost, to protect your family. In your earlier years of your career, without a doubt, the most valuable thing that you have for your household is your income, right? Say you're making $100,000 a year over the course of 10 years, that generates $1 million in income to your household, right? So life insurance is a way of really padding the uncertainty that comes with life, knowing, hey, if something in our picture here, if something happened to Steve, Janet and Mila can still maintain their lifestyle. So that's one of the biggest key factors is when you're younger, you should have term life insurance because it's a lot cheaper than permanent coverage just to really fill in these gaps. Because when you're younger, you're still accumulating. You and your surviving spouse and surviving kids wouldn't have alternative sources of a big 401k already saved because you're still accumulating it to tap into to kind of float you. So that's why you want more coverage the younger you are. Permanent coverage becomes more and more important over time. So reason two, cash and credit when you need it. So say you've had these accounts, you've built up a considerable amount of income and cash value into them. When you need it, you've got this pool of money. It's less applicable right when you start a policy, but once you've had one, you've got some cash cooked up in there. It gives you an alternative source to tap into if your roof breaks down, you need to buy a new car, you buy a new house, some big unforeseen medical expense happens. You don't want to have to put all that, like the picture here, put all that on a credit card that's going to charge you 30+% interest. You already have a pool that you can access tax-free, penalty-free for whatever you want at whatever age. So it's another benefit. Reason three here, as you're getting older, it's going to give you that additional security in retirement. I'm currently studying for, it's called the RICP exam. So a registered, sorry, I guess I'm not studying that good. A retirement income certified professional course. So it's basically looking at what are the best ways to optimize income in retirement. And the best way to optimize income in retirement is having the flexibility to weather whatever happens in the stock market. So adding financial security means giving you a pool of money that you can tap into when the market's not doing so hot to continue to sustain your lifestyle and give your other assets time to recover. Right. Reason 4, having help with long-term care expenses. So as you get older and these policies have cooked up more death benefit, more cash value, we can use either the cash value to help cover these costs, or as I mentioned, if when you took it out, there was a long-term care rider on, and we can work to accelerate your death benefits to pay for a nursing home or even in-home care. The last I checked, I've heard of people paying up to $12,000 a month to be in a nursing home or a memory care facility. Um, that's one of the biggest growing things in America, actually, is access to memory care. So a lot more people are developing dementia because we're living older and older. Even if they're in good health, they can't be trusted to live on their own anymore. And that comes with a significant cost. And the last thing you would want, especially too, I've seen $1 million estates get bled through in 5 years because of these costs, because they didn't have some kind of leveraged contingency plan for them. So through life insurance, you can actually leverage your death benefit to help cover these costs. And then lastly, like I said, the 5th reason, and this is a huge one for people when it comes to estate planning and legacy planning, is that life insurance helps leave a legacy, and it's a big lump sum of tax-free income. You can have it pay into a trust. You can have it pay out to whoever you want. I see a lot of people naming charities as the beneficiaries too. It's truthfully whatever you want, but it's a way that you can guarantee leaving behind a big tax-free benefit. And on that note, going back to our long-term care stuff, life insurance benefits are not something that you have to spend down or get rid of to become eligible for Medicaid. Okay. So in our example here, if you're spending down all your income and eventually you run out of like your 401k and stuff like that, you can qualify for Medicaid. Well, then you're not leaving behind anything, right? With life insurance, they actually don't count that as an asset, like your death benefit on life insurance. So it's a way that you can guarantee with certainty, with whatever happens to you or however expensive it gets, that you're able to transition this, especially if you own a business, you can help do buy sells and stuff like that. But there's a lot of different ways that we can do that. So I ended a couple minutes early here. If anybody does have specific questions, please reach out to me directly. All of my numbers and emails should be on all of the contact info that I've sent over to you guys. But I know this is a complicated topic. It's very personalized. So I really do urge you, like, if you have specific questions, reach out to me directly. I'm very happy to extend myself as a resource. If you want to have a conversation, I don't charge for individual consultations. I found it to be prohibitive of constructive discussions. If I just say, yeah, it'll be $2,000 to talk to me, technically I can't charge that. And I just don't like to. I'd rather help as many people as I can. So, I'll have my juniors reach out to everybody to see if you are interested in just a quick chat with me. If you have questions about this concept directly or anything as it relates to your financials. But I know it's a beautiful summer day out there. I'm sure you want to get back to work or hopefully get outside sometime today. So I will let everybody go. Thank you again for attending the webinar, and keep an eye out for what we're going to be doing next month. Have a great day, everyone. Bye.